What's going on, guys? So Apple stock took a major dip today. It was down almost 10% on the day. And in this video, I wanted to go over exactly what caused that crash and exactly what my opinion is of the crash now. Whether I think that Apple is now trading at a buying opportunity level, or whether I think the company is still overvalued and I think it can continue to drop even further. Now, the way I'm going to be doing this in this video is I'm going to be looking at Apple, what happened that caused their massive dip, and then also giving my bull and my bear thesis as to what I think is going to be going good and going bad for the company over the foreseeable future. And then I'm going to be looking at different financial models that are kind of going to justify with numbers whether or not Apple is currently at a buying opportunity. So if you guys are interested in that, make sure to stick around to the end of the video, and hopefully you guys get some use out of this. If you guys are new to my channel, my name is Dan, and this channel is pretty much a documentation of my investment journey. And I'm going to be documenting, my ideas, my thoughts, and overall successes and failures in the stock market, side hustles, anything like that. So that way you guys can kind of use me as a template for any type of, venture that you want to do in the future. You can pretty much use me as a primary source. So without further ado, let's get into the video. Now, if you guys were looking at the stock market today, Apple's stock tanked drastically today. They were down almost 10% on the day, and that is mainly due to the fact that Tim Cook came out with a letter to shareholders that kind of spelled a lot of worrisome notes for the company in the foreseeable future, especially in the short term. However, there were a couple of positive points that I'll be getting into in just a second with that letter, but Wall Street and the majority of investors and fund managers are pretty much only focusing on the negative impacts right now of that shareholder letter. So running down the list, revenue guidance was now lowered, and this was the first time in I think 5 years or so that Apple has now lowered their top line growth, and so they're lowering their growth by about $9 billion, and that is largely due to the weakness in China. And as China currently stands at about 20% of Apple's total revenue, anytime that China faces weakness and that their overall GDP starts to slow down, it's going to drastically hit Apple with having nearly a fifth of their revenue coming directly from that country. Now, it was important to note that Tim Cook did mention that the other metrics that they talked about the last time that they gave guidance onto this quarter are reasonably the same, and they're expected to continue to grow accordingly. However, just because of China and their weakening iPhone sales demand in China, their revenue is going to be taking a hit in this quarter and then for the foreseeable future. Now, in a couple of positive notes, active devices of Apple have now hit an all-time high. They just added in, I think, 100 million units just this past quarter. So that now has made Apple, have more devices than they've ever had out before. And when you look at revenue outside of the iPhone, they're expected to continue to grow at about a 19% clip. And so when you look at, Apple as a whole company, yes, obviously the iPhone is where they take the majority of the revenue from, but with the fact that all of their other revenues put together are still growing at about a 19% rate, that is still nothing to sneeze at. Tim Cook also mentioned that they are still on track to double their service revenue from 2016 to 2020. With the foreseeable future, they do not see any kind of impact on that. Even with the weakening in China, they do think that their service revenue is going to continue to grow at an extremely fast rate. If you look at it over the past couple of years, it's been growing at about anywhere between 20 and 30% depending on the quarter rate. And so I personally do think that services are going to continue to be, one of the major growth drivers for Apple in the foreseeable future. Wearables saw an amazing increase of about 50% year over year, and this is pretty important when you look at Apple trying to diversify what type of products they're selling to the end consumer. So now, even say if not everybody's upgrading their iPhone like they once were, now people are going to have another device in their ecosystem, their personal ecosystem, that they're going to continually upgrade over time. And with the more and more widespread adoption of wearables, this is just going to be another, cash cow for Apple, over the long term. And due to the share buybacks and along with how they've, kind of maintained really high margins, Apple is expected to now reach all-time high EPS, and they do not expect any of the issues with China and their direct revenue to affect their bottom line EPS growth. So that means that the company is definitely innovating in different ways that are still making them just as profitable, even though their top line revenue isn't growing as fast as they wanted it to. Now, so the next thing I wanted to look at was the company's balance sheet, because obviously every company will go through a couple of quarters of, weak growth in one metric or another, but it really depends on their financial stability on whether they can weather through that or whether the company is in for a rude awakening in the future. Now, if you run down their balance sheet, you can look at their cash position of about 131 billion, their total assets of 366 billion, and then you compare that to their current liabilities of 116 billion and their total liabilities of just 259 billion. My overall takeaway from their balance sheet is that Apple is in a fairly strong financial standing. So that means that even if they have multiple quarters of, say, not stellar growth, the company does not really necessarily have to worry about, say, going bankrupt. drastically contracting or anything of the like, because they definitely have enough cash on hand to kind of weather the storm of whatever happens, especially as this trade war continues on. And because no one really knows the time frame of how long this trade war will last, it is definitely reassuring to know that Apple is sitting on a massive amount of cash. So as I said earlier, I came up with two major theses about why things are going to be going good for Apple and why things are going to be continuing to go bad for Apple. And so starting off the list with my bear thesis on Apple and kind of the reason why I think that they are currently in troubled times and why those times might continue on into the future is that if you look at smartphone sales over the past couple of years and you look at smartphone innovation, and you pretty much find nothing. There has been very little innovation over the past couple of years with smartphones, especially at the premium level. So you really don't have that much of a cash grab from end consumers to just really wanting to go out and upgrade their phone because of this miraculously cool new innovative feature. And in my opinion, until that happens, which probably won't happen in my humble opinion until we hit about the 5G bracket, which isn't supposed to be happening for about 2020 at the earliest, especially for Apple, you're not going to have this massive flood of people to buy their new smartphone. You're not going to have that iPhone super cycle to really come to fruition, at least for the foreseeable future, because there's really no innovation in their phones. You can also look at Chinese manufacturers such as Huawei that have drastically been improving their quality of their phone over the past couple of years. I've made mention of it a couple of times on this channel, but I know people that have Huawei phones here in America. And honestly, I'm blown away with the amount of features and everything that was put into the phone and the price point that they bought it at. And now Huawei has definitely been increasing their market share in China. And essentially, when you look at that, it's because if the Chinese economy is, weakening, or if it's going to be, kind of rocky for the foreseeable future, you pretty much have a standard economic shift, and people are going to be going from the premium goods to the inferior goods for the short term. So that means that companies that, say are trading at half or selling a phone at half the price, but have 90% of the features that, say, the premium models have, that's where everybody's going to be putting their money to. When you have an explosive growth period like we did in 2017, obviously people are going to be willing to justify, their premium purchase for that top-of-the-line smartphone, but that just isn't the case, at least currently. So until, the trade war settles, easing the waters between the US and China, I definitely can see this continuing into the future, that Apple is not going to be the main phone to buy if you are an end consumer in China. And so those are kind of my main points as to why I think that this type of downward spiral can continue at least over the next couple of quarters for Apple. But this is just the negative side of it. Let's go into the positive side of why I think Apple could actually turn this around, in the next, say, year or so. And also getting into my bull thesis is that we've essentially seen this type of a life cycle happen in, whether it be smartphones, devices, computers, tablets, whatever type of technology boom and cycle that you look at, you eventually hit these troughs that are, filled with little innovation. There's really no consumer demand because they can pretty much get all of the features that they had with their current phone, and there's no real need to upgrade. However, this is just a natural occurrence. This happens because as technology goes to innovate and people want the newest thing, eventually we kind of hit a waiting point where, okay, everybody has, essentially the same phone, whether you bought one generation or 2 generations ago, and now we're waiting on the next big wave to make all of the people that are just kind of getting the most life out of their phone to really kind of, ante up the price tag that Apple is now charging and really upgrade to the newest phone. However, I don't really see this persisting, over the long period of time. I can definitely see in 1 or 2 generations of phone, this kind of reverting back to the mean and people continuing to upgrade their phone every year or every other year as they normally do. Another important thing for this thesis is that Apple is definitely focused right now, and it was mentioned in their shareholder letter, which again is linked in the description down below, is that they are now trying to focus on branching their revenue streams, not solely dependent on the iPhone. So right now, over the past couple of years, the iPhone sales have been about 60 to 66% of the company's overall revenue. However, with the expansion of services and with wearables becoming more and more popular, they're really trying to diversify even within their own company to really make that ecosystem more broad-based for individual users, not necessarily trying to get everybody on the planet having an iPhone. And I think that that's a better strategy for someone like Apple, because Apple is known as that luxury product. They're known as having a robust ecosystem. And if you can sell 5 units to one individual instead of selling 1 unit to, say, 4 individuals, I think that that's a better marketing strategy for Apple in the foreseeable future, especially with how much market share they've already acquired. So when you put my two theses together, you essentially get this, and that is that Apple, in my opinion, is going to continue to be one of the strongest brands and one of the most valuable brands over the next decade or two without question. I definitely do not see anything, fundamental changing from the consumer base or anything of the like that is going to tarnish Apple's reputation for being one of the most premium products in the world, and I do not see anything wavering in that category. You can also see that, the current doomsday, environment that's going on with Apple, because they just now, for the first time in a very long period of time, have kind of lowered their top numbers. I don't really see that being anything that's fundamentally changing. Now, obviously, every company can have a quarter or two or even a year or two where things aren't going as well as they anticipated. And a lot of this is due not to the fact that Apple, isn't making good products and they're starting to have a lot of negative publicity. It is simply the fact that we are in very turbulent times in a macroeconomic setting. I will not blame the company for that, and I actually applaud the company for being able to navigate it relatively well and unscathed in the short term, because that's something that is completely out of their control, but they're navigating it very well. And so I'm not really anticipating any of this doomsday type of opinion to really go on for the foreseeable future. And it actually is interesting because now it's starting to kind of take off that premium that Apple normally sells for. And my overall opinion is, if I already own the stock, fundamentally, I don't see anything drastically changing for the company, and I also don't see any reason now as to, if you bought in the company a year ago, with what had just happened, I personally, if I had owned shares, I would not justify this as a time to sell. If anything, it could be a potential buying opportunity, because essentially the long-term thesis of Apple is unchanged. Yes, there are issues with China, and there are issues with, emerging smartphone manufacturers coming in and trying to eat away market share. That's fine. That's been happening to Apple since the 90s. It's not really anything new, in my opinion. What is important for Apple in the foreseeable future is that they maintain their brand, and they also maintain their ecosystem, and they're able to make their ecosystem even more robust, which I think is what the company is doing. However, I should say that because I do not currently own Apple, I'm going to be going into a couple of financial models to really justify whether or not I would personally buy Apple shares currently for what they're trading for, if I'd hold off, or kind of what my thoughts are about that right now. But essentially, my overall takeaway is that Apple is still the company it was a month ago before this massive sell-off. It's still a company it was a year ago when it was at its all-time high. I definitely do not think that anything fundamental has changed with Apple. Now, the first model I wanted to go into is a model that I have already gone over on this channel. If you looked at my 3 stocks to buy in January, Apple was one of those companies where I pretty much looked at the discounted cash flow of the company and assumed that the company is going to be growing at a 13% EPS growth rate over the next 5 years, and that the overall market can return, say, about a 15% year over year. And now, obviously, the market returning 15% year over year for the next 5 years is a bit unlikely, and a lot of people can say that that is, giving way too much credit to the overall market. However, when you're doing a discounted cash flow, it's better to be on the conservative side, meaning that the overall market is going to perform better than you think it's going to be, because it allows you to have more of a cushion for error and a better margin of safety. Based off of those metrics, you get a current fair value for Apple at about $131. And even after their 10% dip today, they're still sitting at about $142. So they're still trading at about a 7 to 8% premium based off of that, and that is not including a margin of safety. And now, me personally, if you guys have been following my channel, I like to have about a 30% margin of safety whenever I'm invested in these companies. So by the discounted cash flow model, I would not be buying into Apple until it hits about $90 to $92 a share. Now, I will say that there are many other models to use. I'm going to be using in a very different model for more focused on growth in companies. But this is just a kind of a way that I look at Apple of a risk-to-reward perspective on what would the raw value of that company be, assuming nothing else, and assuming I don't want to give any special premium to the company because it is a company like Apple. Now, using the PEG model, which is the price-to-earnings ratio divided by the earnings growth rate, you essentially get a slightly different story than the discounted cash flow. So if you look at their PE currently right now after the major sell-off, you sit at about an 11.7, and with an EPS growth rate of about a 13% over the next 5 years, you get a PEG of about 9%. So that means that the company is currently trading for, assuming that a company should be trading for its growth rate, such as investors like Peter Lynch and other growth investors and other value growth investors have done in the past, you essentially get an 11% discount if you buy Apple shares right now. Now, the flaw with this is that if their EPS growth rate does change over the next 5 years, that could throw off this model drastically. However, with Apple currently reassuring that their EPS growth rate is on track to maintain the way that they've been going at, and they're not changing their guidance in their EPS bracket, I think it's okay to assume that 13% is reasonable for Apple over the next 5 years. And If you're looking at, say Apple from a growth perspective and not necessarily from a value perspective, you might see more of a discount right now than a, bare bones value investor. So while I personally would like to see, their PE, giving myself that 30% margin of safety, I would rather see their PE drop to about a 9.1 before I start my position. But if you're looking for a growth play and you're pretty much focused on, what is a premium brand that grows really quickly, that is a reasonably safe company, and it has a strong balance sheet, I think Apple is definitely worth putting on your radar. I just personally wouldn't start a position with this type of a discount from their growth rate. So when you look at their, their discount from their growth rate and their premium from their price to cash, from their cash flow, I'm personally not starting a position solely off of this. But if you have a different type of investment philosophy than I do, it would definitely be worth taking another look at. And now, obviously, since I'm just a college student that's 22 years old, why don't we take a phrase from one of the greatest investors of all time, who currently owns Apple and is currently buying more of Apple, and really see how he views the company. And so I'm going to be quoting Warren Buffett here and saying that it is better to buy a great company at a fair price than it is to buy a fair company at a great price. And essentially, I do think that this kind of holds true for Apple. I think Apple right now is not trading at a massive premium. I don't think it's trading at, a severe discount, but I think it right now is sitting at around a fair value. So if you ask yourself, would you rather buy a great company at a fair price, or would you buy a fair company at a great price? So if you're someone who's looking for a great company trading at, fair value to a little bit of a discount, I think Apple is definitely worth keeping on your radar and even looking into further, because I do personally believe that Apple is going to outperform the broad market over the next 10 years because of the amount of innovation they have, the moat that they have, and kind of the way that they've been able to stand the test of time with growing significantly faster than everybody anticipates. As you can see, Apple has been trading at relative discount for a while now over the past couple of years, and it has drastically outperformed the market and all of its competitors. So if you are already invested in the company, obviously I'm not a financial advisor, but if you're already invested in the company, I personally do not see any reason why you wouldn't like the company anymore, and I wouldn't go against the, say, implementing, Benjamin Graham and Warren Buffett's approach to dollar cost averaging into great companies. You could dollar cost average the company now. It is definitely not trading at a massive premium anymore. Not to say that it was, but it's definitely not there right now. And you can probably continue to dollar cost average in the company, and it will probably perform better than the S&P over the long period of time. Now, obviously, you take on a lot more risk than just dollar cost averaging into the S&P this way. However, based off the fundamentals, assuming nothing drastically changes, I do think that that is what's going to be happening over the next decade. So if you guys stuck around to the end of the video, let me know what you guys think in the comment section down below. Are you guys buying Apple? Do you already own Apple? And what are your thoughts on their shareholder letter? And has that changed your view of the company at all? I'd love to hear you guys' thoughts. And again, thank you for watching, and I'll catch you guys in the next video. Peace.